Forget the daily noise. There are critical credit risks building up that could seriously derail this market. So here's my analysis and how I'm positioning for the next 1 to 3 months.
So the real question we have to ask ourselves is this: is the market just completely ignoring the cracking foundation of credit that's holding up these valuations? I think it is, and here's exactly why.
Okay, first let's get the surface level news out of the way. This is the stuff that's driving the daily chop, and it's mostly a distraction from the real story.
Right, so you've got Palantir just chopping around ahead of earnings. That's a known catalyst. Then there is the US-China talks. Expectations are basically zero, so that's not moving the needle. And of course, political headlines are creating noise in pharma and industrials. Look, this is all just short-term chop. It is not the real story.
Now, let's get to the actual thesis. We've got to look at what isn't being talked about nearly enough. Two big, interconnected credit risks that are building up around private assets and the financing of this whole AI boom.
This number right here, this is the critical data point. We're talking about an $800 billion minimum funding gap for the AI infrastructure buildout. You know, private markets were supposed to fill this gap, but the data shows they're failing. And that right there is a massive risk.
You know, Mike Green from Simplify calls this volatility laundering, and it makes perfect sense when you look at the numbers. Private equity is out there claiming returns of plus 113% over 5 years. But their publicly traded levered equivalents, they're down 6%. This tells you the private returns are basically an illusion, totally unsupported by real-world performance. This is a house of cards, plain and simple.
And this brings us right to the first major structural problem, the financing of the entire AI boom itself. How is this all being paid for? This right here illustrates the problem perfectly. Okay, just follow me on this. You've got a super leveraged company like Oracle borrowing massive sums to buy NVIDIA hardware. Then their main customer, OpenAI, commits to a deal that's 6 times its annual revenue. To keep this whole thing from falling apart, NVIDIA then turns around and finances other AI firms to create even more chip demand. This entire structure is built on leverage and needs a continuous flow of capital. It's a classic vendor financing scheme, and let me tell you, it is incredibly fragile.
So these are the tickers you need to be watching. Of course, NVIDIA and Oracle are right at the center of this loop. But the real canaries in the coal mine, they're the private credit firms. Blackstone's BDC, that's BXSL, is sitting at a 2-year low. Blue Owl Capital, OWL, is basically falling off a cliff. This is a huge red flag coming from the very markets that are supposed to be funding this whole operation.
The parallel here is just direct and unavoidable. This setup perfectly mirrors the vendor financing schemes that led to the collapse of companies like Global Crossing back in the dot-com bust. You know what they say? History doesn't repeat, but it sure does rhyme.
Okay, before we get into positioning, here's the mandatory disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
So given these risks, here are the 3 scenarios I'm modeling out, and exactly how I'm posturing for each one. All right, my base case, the path I see as most likely, is a period of really tense consolidation. The market just kind of chops around in a range through earnings season, but that stress in private credit tickers like BXSL and OWL keeps building under the surface. My posture here is defensive. I mean, reduced delta, a higher cash position, and I'm definitely holding onto my portfolio hedges. Now, the bull scenario, this one actually bypasses the tech credit problem completely. This would be a government-backed, national security-focused onshoring supercycle. The trigger, new government grants for domestic rare earth mining to counter China. The play here is a rotation into domestic commodity producers, think MP Minerals, and ETFs like Ramex. And then there's the bear scenario, the credit contagion. This is the tail risk. The private credit market freezes up, that AI financing loop I mentioned breaks, and the risk just spills over into the public markets. And it happens fast. You'd watch for a sharp break in the QQQ and a blowout in high-yield credit spreads. A trigger could be a major fund like BXSL gating redemptions. The posture here is simple. Net short, long volatility, and a laser focus on capital preservation above all else. So let's distill all of this down into the 2 core theses that are going to drive my trading over the next 1 to 3 months.
The bear thesis is pretty straightforward. It's a direct replay of the dot-com bust. The catalyst is the failure of private credit to fill that $800 billion funding gap, which forces a halt in AI capex. Capital would just flee from names like NVIDIA and Oracle. You have to watch for a breakdown in BSL and OWL. This thesis only gets invalidated if we see unexpectedly strong earnings and upward capex revisions from the big hyperscalers. To be clear, this is a high-conviction thesis for me right now.
Now, the bull thesis, it ignores the tech narrative completely and just focuses on geopolitics. The catalyst here is aggressive U.S. industrial policy to onshore the production of rare earth minerals. Capital rotates out of tech and into domestic producers like MP Minerals. You'd watch for breakouts in RMX on any policy news. Invalidation would be some kind of major diplomatic thaw with China, which, let's be honest, seems highly unlikely right now.
Okay, now let's talk about some defined risk structures to actually express these views. And just to be clear, these are not recommendations, but frameworks for how I am thinking about positioning my own book.
All right, first up, a setup to position for that credit contagion scenario, expressing a bearish view on the NASDAQ 100. For a 1 to 3 month time horizon, a put-debit spread on the QQQ is a solid, defined risk way to hedge or speculate on a tech downturn. The beauty of it is it benefits from directional weakness while limiting your theta decay. The thesis is invalidated if the QQQ breaks and holds its recent highs. For me, this is a starter hedge position.
Next, a structure to get some exposure to that rare earth mineral steam, which would be driven by the national security and industrial policy catalyst.
For the bullish onshoring thesis, I'm looking at a longer-dated call or maybe a call debit spread on the REMX ETF. This is a longer play, 6 to 12 months, on a structural geopolitical shift, trying to exploit a sustained policy tailwind. This is a speculative position, so you have to size it for a potential total loss of the premium you paid. And the thesis fails if we see a significant de-escalation with China.
And finally, our closing disclaimer. This is not trading advice. Markets carry risk. You need to trade your own plan, manage your downside, and always verify all data.